One year, millions of Americans stop borrowing. Credit card balances shrink. Car loans disappear. Mortgage applications collapse. At first, it sounds like the financial dream everyone has been waiting for. But then, businesses start cutting jobs. Home prices begin falling. Banks stop lending. Entire industries suddenly freeze. How could people doing the financially responsible thing trigger an economic crisis? And what does that reveal about the system we've built? By the end of this video, you'll understand why modern economies don't just tolerate debt, they quietly depend on it. We'll uncover what really happens when borrowing slows, why governments fear credit freezes more than recessions, and why escaping debt isn't as simple as financial gurus make it sound. Here's the first surprise. In the United States, consumer spending makes up roughly 2/3 of the economy. A significant portion of that spending is financed directly or indirectly through credit. If borrowing suddenly stopped, the shock would spread far beyond banks. It would reach nearly every business and household. So where does that chain reaction actually begin? The day everyone became responsible. Picture an ordinary Monday morning. Millions of people wake up and make the same decision. No more financing. No new mortgages. No auto loans. No buy now, pay later purchases. Credit cards are paid off and locked away. Financial advisors would celebrate. Families would feel relieved. For the first few weeks, everything seems healthier. Household debt starts falling. Savings slowly increase. Banks receive more repayments than new loan applications. It looks like America is finally fixing one of its biggest financial problems. But beneath the surface, something strange begins happening. Car dealerships suddenly lose buyers. Not because people don't want cars, because very few people can take $45,000 in cash. Home sales slow dramatically. Not because houses disappeared, because most families simply can't purchase one without a mortgage. Furniture stores, electronics retailers, construction companies, vacation businesses, they all notice the same thing. Customers haven't disappeared. Their ability to spend has. And that's when the first cracks begin to appear. The engine nobody notices. To understand why this happens, you have to look at how money actually moves through the economy. Most people imagine banks taking someone's savings and lending it to someone else. Reality is more surprising. When commercial banks approve many types of loans, new bank deposits are created in the process. In other words, much of the money circulating through the economy begins life as debt. That changes everything. When businesses borrow, they hire workers. When families borrow, they buy homes. When companies borrow, they build factories. Debt doesn't just finance purchases. It accelerates economic activity years before people could afford those purchases outright. Think about a young couple. Without a mortgage, they might need decades to save enough money for a house. With a mortgage, construction workers get jobs today. Furniture stores make sales today. Electricians, plumbers, landscapers, moving companies, they all earn income today. One loan quietly supports dozens of businesses. That's the hidden multiplier. And once borrowing slows, that multiplier begins working in reverse. When less debt becomes more dangerous. Here's where the story takes an unexpected turn. Most people assume less debt automatically makes the economy stronger. For one household, that's often true. For millions of households making the same decision at the same time, the outcome can be very different. Businesses notice falling demand. Sales decline. Expansion plans are canceled. Hiring freezes begin. Then, layoffs follow. Workers who lose income spend even less. Businesses lose even more customers. Banks become cautious. They approve fewer loans, which means even less spending enters the economy. Economists sometimes call this a balance sheet recession. A period when households and businesses focus on paying down debt instead of taking on new borrowing, slowing economic activity. What started as financial responsibility can spiral into economic contraction. History has shown versions of this pattern before. After major financial crises, households often reduce debt, banks tighten lending, and recoveries become slower because spending takes years to rebuild. But if debt is so risky, why would governments want borrowing to continue? That question leads to the biggest reveal. Why governments fear credit freezes. During every major financial crisis, one thing happens almost immediately. Governments rush to restore lending. Not because debt is perfect,